I think we're like on a seesaw. Either we're going to get a total collapse, like deflationary collapse, and because we're seeing the M2 money supply starting to go down, or we're going to get hyperinflation um, because the central banks are going to keep, restart their QE, and we saw that the Fed did that in March. I think they neutralized almost half of the QT they had done.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming back Mario Innecco. So, Mario, thanks for coming back on the podcast today.
Oh, you're welcome, Anthony. Nice to be on with you.
Yeah, I'm really looking forward to that conversation because last time we were talking a lot about, I guess, maybe issues that we've recently seen. So, we're talking about a currency crisis, but we also talk about maybe challenges that banks would be having and other fragilities would be seeing in the market. So, I guess, we talked close to 5 months ago. Since then, what are the real changes that you've seen? And I guess, what are you looking at in the market?
Well, I mean, the huge thing that's going on now is that we are having a banking crisis in the U.S. and it's spilling over as well. We saw Credit Suisse collapse; they had to bail it out, take over, and today as well, J.P. Morgan had to take over with the help of the FDIC, of course. Um, they took over First Republic Bank. I think it's the second biggest bank failure in history. And it reminds me of 2008 when things started kicking off because JP Morgan back then also took over Bear Stearns. And then that was in March. And then about 9 months later, the whole system almost imploded with the Lehman collapse. So the markets themselves, they're still heavily manipulated. And it looks like the central banks and treasuries, they're doing everything to keep things going. But the other thing that's changed, though, is that people are realizing that we don't have Goldilocks. And what's Goldilocks? Well, Goldilocks was a term they used a lot in the 90s and early 2000s, that everything was just fine. The not much inflation, the markets were going up well, interest rates were low, and everything was fine. And in this environment, yeah, things just keep ticking along. But I think we're like on a seesaw. Either we're going to get a total collapse, like deflationary collapse, and because we're seeing the M2 money supply starting to go down, or we're going to get hyperinflation. Because the central banks are going to keep, restart their QE, and we saw that the Fed did that in March. I think they neutralized almost half of the QT they had done, and yeah, so we don't have Goldilocks, and I think in that environment, it's very dangerous to be in the markets, be it in bonds or equities. And that's why I still favor having some physical gold and silver outside the system. Yes, you might want to speculate in the stock market, but beware that I don't think everything's fine.
Yeah. So do you see maybe other banks, as you said, there's a potential for either or, but do you see other banks potentially coming under risk and coming under pressure?
Well, they're using all the same model, and we've had four failures in the U.S. this year: Silvergate, SVB, Signature, and now First Republic. I don't really follow closely each bank and look at the numbers, but I would say that yeah, it's not just in the U.S. Here in the U.K. as well. Things could get worse for the banks. I think in the U.S. one of the reasons is that the banks, they a lot of the regional banks, they bought a lot of mortgage-backed securities, i.e., they lent they lent out, and mortgage rates have gone up, and U.S. consume, the people who borrowed to buy their homes through a mortgage, they're okay because they're able to fix it. So now it's the lenders that are getting in trouble. Here in the UK, the mortgages are more short term. They're like 2 or 5 years. And in the US, you have very long term mortgages. But No, I think despite the fact that we're hearing today, Jamie Dimon, CEO of JP Morgan, and the US Treasury and regulators saying, "Oh, everything's fine. Your deposit is fine." To me, to me, it screams of no, everything's not fine when you hear these kind of people saying one thing. Because if everything was fine, they wouldn't have to tell us that everything is fine.
Yeah, we're seeing that they're breaking the laws left, right, and center. So I think with Credit Suisse, they didn't go to the shareholder vote. They just it just got acquired straight away. And I think in the US as well, banks with more than 10% of national deposits aren't meant to be able to acquire other banks, which they've
Yeah,
thrown away now with JP Morgan with 16%
yeah,
of deposits buying that.
I- yeah. There's a rule, I think, in the U.S. for banking that if a bank gets up to 10% of all deposits in the US, they can't take over another bank. And they had to like basically scrap that rule for JP Morgan and to take over the assets of First Republic. And shareholders, bondholders, they've been wiped out. But I guess depositors, even with more than 250,000, they'll be okay because JP Morgan is now taken over those deposits. But I'm sure that there's a lot of reassurances from the FDIC, the Fed, and the Treasury to JP Morgan, and it seems to always be JP Morgan who takes over all these banks. It's not surprising because JP Morgan is probably one of the biggest shareholders in the Federal Reserve. They are the central bank. Prior to the Fed being founded in 1913, it was JP Morgan that used to organize a lot of bailouts when you had crises like 1907. I think 1893, they helped bail out the US Treasury. So they have a long history. It's almost like JP Morgan really runs the US.
Yes, but as you said, it's back to what was happening a century ago before the Fed. So yeah, that's really interesting. And I think my concern is, you could say the UK, there's other banks that maybe could, if a massive one of the big banks went under, maybe HSBC, Barclays, one of those other ones could potentially bail them out. But I feel like there's, so say Deutsche Bank in Germany, I can't think of any other big banks that would actually be able to take on, the balance sheet of Deutsche, and then it would have to be the government. And then we saw what happened in the UK in 2008 and how bad that was for, I guess, the average person.
Yeah, I mean, Deutsche Bank has been like a zombie bank for many years. And surprisingly, Credit Suisse went before they went. But all these too big to fail banks, like the ones that are, yeah, like in they're called GSIBs, um, yeah, globally sensitive institutions or something. I forgot exactly what it stands for. Yeah, they have, aside from having just normal, how normal, excuse me, high street operations, they're huge into investment banking and they have a lot of derivatives on their not on their book. Yeah, it's on their books, but off balance sheet, and it's really hard to say how leveraged they are. They're very dangerous, and unfortunately, that was part of the scrapping of Glass-Steagall in the U.S. in 1999, where Glass-Steagall used to divide. If you were a deposit-taking bank, you couldn't get involved in riskier business like investment banking, and that was scrapped. And here in the UK, the same thing happened. We used to have the merchant banks or investment banks that used to be involved in riskier things, and the high street banks like Barclays, HSBC, NatWest, they did boring commercial lending and high street banking, but it's all mixed now, and that's why it's so dangerous. And I don't think there's any bank that is really safe anywhere in the world, but it's starting in the US, and I don't think it's over by any stretch.
Yeah, could you see maybe a move away from fractional banking? Because I guess the main issue has been that only a certain percentage of deposits are actually held on the balance sheet, and the rest is either sent, pushed out to mortgages or other assets. Could you maybe see a reversal of that? And there's been talk that you actually might have to pay a bank just to keep the deposits 100% in in the actual bank. Do you see something like that happening?
Well, I've spoken about that because, like Mervyn King, the governor of the Bank of England from 03 to 2013, he wrote a book and he said that could be an option. But right now, the bankers are so much in charge of everything. You see who runs the UK. They're all former bankers, hedge fund managers. Um, Fractional reserve banking is, I think it's a fraud because you're lending something you don't have. And it goes back to like the Renaissance, where the money changers used to, they saw that people didn't come every day for their money, so they used to lend it out, and a lot of times they lent out money that they didn't have. So that's what it is. Yeah, in an ideal world, if you're able to save enough real money, and you save a lot, then yeah, you put it with someone that you can trust, that looks after it for you, and they'll charge you, of course, for that. And that's what it should be, banking. And someone might ask, what about lending and funding small businesses? Well, that's a different kind of bank. That would be an investment bank, and you would know that your money would be more at risk because you're speculating on whether a company or a business is going to do well when you lend it out, maybe through equity. Uh, and those would be separate from a deposit taking bank. Yeah, so that's how I see it. But right now, there isn't any political will for that. I think that could happen uh, when the whole system implodes, but I'm sure they're going to try, the people in charge, they're going to try to bring their own solution. And a lot of people are talking about CBDC, and CBDC wouldn't be any different from what we have now. It would still be fractional reserve banking, but through a central bank digital currency. And their excuse is that, well, if you don't do fractional reserve, the economy can't grow. But our economy hasn't been growing that well since 2008, not just here in the UK, but throughout the West. Growth has really slowed down. The only reason we have positive GDP is that government has been spending more and more, deficit spending more and more as well. We just had the deficit numbers for the UK for the last fiscal year was 139, I think 139 billion pounds, which is like almost 6% of GDP. So yeah, it's not a good excuse to have fractional reserve banking.
Yeah, as you said, it definitely doesn't seem to be helping at the moment. So really what we're talking about is almost what people currently do with gold. So they and gold storage, I guess, locations where they just ask someone to look after the gold, and they give them sort of or they pay them a percentage. So it sounds like that's really what's happened, but I guess you could say it's maybe a a more appreciating asset
Yeah,
generally than currency.
I mean, it started out like that, like the goldsmiths in the city centuries ago. They would safekeep people's gold coins, but as I said, people didn't come every day to take all maybe only 30% of the people came, or 20% came every day to maybe take their money out. So they started issuing promissory notes, and that those promissory notes, they became almost as good as the gold or the money. um, and then gradually through the centuries, because of wars and crises, they've suspended that. And nowadays, people don't even know really what money really is, and they think that the money that we use, the cash, they call it cash, the promissory notes, is actually money, but it's not. And even cash, uh, the paper note, that's not cash. Technically, gold and silver coins are cash or specie, but that's that's been far gone. Yeah, in an ideal world, that's what would happen. We'd probably keep quite a bit of our gold, if you're fortunate enough to be able to save with a bank, and the silver would be just for day-to-day transactions, for change, and you don't have to keep that in the bank. You keep that with you, some silver coins. um, yeah, that would be an ideal world, but right now we're under the control of the fractional reserve bankers.
Yeah, definitely. So if we go back to a point that you were mentioned talking about before, it was you said that we could either see maybe a hyperinflation due to increase in QE, or we could see sort of a mass deflation. So maybe can you describe why those are two options, and what would cause that?
Well, because the debt has gotten so huge, and the other side of the debt is the currency in a fiat currency system. So if the debt doesn't keep growing, the whole system implodes on itself. And right now, the Federal Reserve has been raising rates, and they've gotten M1 and M2 to start dipping about 4, maybe 5%. And that's dangerous because they could lose control like they are right now with the banks, and everything could implode. And you get like a major bankruptcies everywhere, not just the banks. You get life insurance companies, industrial companies, the whole economy collapses, the government collapses. That's what we had in the 30s after the 29 crash. The reason why I said you could also get hyperinflation is because if they don't allow, you know, if they see that things are dipping and they start printing again, then people will realize this is never going to end, and they'll lose confidence in the currency, which I think they already are. And so they'll try to get rid of the currency as much as possible for real things. And that's when you get the hyperinflation. So I think we're not going to, as I said, we're not going to get anything in between, or a Goldilocks. And that's why I think, yeah, you need to keep your head down, batten down the hatches, and live within your means, and be very careful.
Yeah, it's being ready for all different possibilities. So if we looked at that, yeah, I can't see the Fed and other central banks, I guess, letting things get to that deflationary level. I feel like they're as we've seen, they're so reactive at the moment. They're doing whatever they can to try and keep the current system going, that I feel like it's potentially would be more likely to be the second option, where they loosen up everything, and as you said, there could be money flying from everywhere, and that could definitely increase inflation and have an impact.
Yeah, well, I think what they're trying to do now is like we saw in October with the Bank of England. They had to do QE to save the gilt market and the defined benefit pension system. It was like putting out a fire. Uh, and they said this is not real QE, but it was. And then in March with the Fed as well, they had to put out a much bigger fire. And today they've put out another fire. The question is whether, they've put out all the fires. And like you said, they probably haven't. And they probably don't want the fire to destroy the system. And either way, deflation or hyperinflation, the debt is going to be destroyed either way. So, but like you said, I think central bankers and politicians prefer inflation because deflation is really it's bad. It's just as bad as hyperinflation, but they seem to think it's better to have inflation because they don't really understand what inflation is, I would say.
Yeah, and I can imagine that some countries will be worse than others. There'll sort of be a competition of what inflation is the worst. So um, I guess if we look at the current currency, we look at the US dollar, it's been really uh, the currency hegemony over the past 40, 50 years. But it does seem like there's been some challenges. We've seen, China and Brazil talking about how they're going to trade in their own currency. We've seen some sort of Saudi rate. Oh, I think it's Dubai oil contracts being settled in Chinese yuan. So do you think that's the start of where there's maybe currency crisis occurs, where these countries actually go off the US dollar, and maybe there's more of a fractured world in terms of what currencies individuals use?
Yeah, I mean, the currencies are already almost worthless, even the US dollar. The reason the US dollar is still used is because of convention, because it's easier and people have been used to it. But if you look at charts of the dollar versus gold, not gold versus the dollar, and other currencies as well versus gold, since 1971, they most of them have lost about 98 to 99% versus gold. So yeah, I think what's happening now with all these countries trying to create their own system outside the petrodollar systems, that they're tired of being told what to do by the US and also being punished with sanctions. So it gives them more sovereignty. Does it mean that their currencies are going to become any good? We'll have to see. Even though a lot of them have been buying a lot of gold in the last year and a half, not the West, but a lot of other countries. So maybe they realize that if their currencies are going to be credible for trade, they're going to have a strong gold backing. But yeah, the dollar is not going to go away, I guess. But I think the use of the dollar is going to decrease, and that means even more inflation because a lot of the dollars are going to go back into the U.S. and there will be a lot less demand for dollars or treasuries by foreigners. So interest rates are going to not go back down to 0 or 1 as a lot of people think.
Yeah, definitely. And I think if you look at maybe some of the countries that used to buy them, I guess Germany and Japan, they're becoming net importers rather than net exporters. So they're not going to have as much money there to buy the bonds, as well as China, obviously looking elsewhere because of the concern that if they might not even have to invade China, invade Taiwan if there's just a risk of them becoming hostile, or the U.S. government thinks it's the right time to do it. They could just basically invalidate all the debt that's owed to them. So yeah, it does seem like for those countries, there's quite a lot of risk in actually holding just exclusively US dollars, and they should diversify to other assets.
Yeah, yeah. I guess that was the lesson learned about from what happened to the Russian reserves.
Yeah, I think an interesting point as well is that it was the euro. So the Russians had lots of euro reserves as well, and they were also, uh, yeah, taken away, basically confiscated. So, none of the big countries are safe if you want to do bad things, or it might not even be bad things. It might just be that you have a different political system, or and I guess that's the precedent that they've set. Yeah. So if we look at my challenge is I don't really see any asset that could come in and take over. Do you think? Because if we look at the British pound and the US dollar, it took about 50 years for there to be a transition. It's from sort of early 1900s till, or once the US dollar came into being, until after World War II. That's how long it took, sort of 30, 40 years to transfer from the British pound being the world currency to the US dollar. I think it would be quicker, but then yeah, do you have any ideas on what that could be? Could we go back to a gold standard? Could it be a cryptocurrency? Or what are your thoughts on that?
Well, I think right now it's uncertain, but it looks like we're going to have a lot of countries um, looking after themselves. There won't be a like a unipolar system, but gold is always the only kind of monetary asset accepted anywhere in the world. So, and even if the Chinese yuan were to become the major reserve currency in terms of percentage held, or if they create a BRICS reserve currency, I would still not trust it because I don't trust fiat currencies. Even and especially if they're not convertible into gold, because they might try their own Bretton Woods, where only governments would settle in gold. But we saw that didn't last long, 44 to 71, 20, 27 years. So there's always going to be the temptation to cheat by by politicians and governments, and I think that's why you need to be your own central banker. You need to have, yeah, of course, you're going to need some of the currencies to to transact on a daily basis, but long term, it's I think having gold and silver is always a good thing as an individual.
Yeah, and I guess are there any other assets, any other hard assets that I know last time we talked about collectibles, I guess we talked about real estate, some land as well, as well as I guess other commodities. Are those really the key things that you think would potentially, protect wealth during that hyperinflation period, the real assets, or is there anything else that you're paying attention to?
Yeah, I mean, I mentioned gold and silver because they're monetary assets, especially gold. If we have a hyperinflation, yeah, anything that's real and tangible will hold its value. So yeah, but I don't give people advice on how to invest. What I try to tell them is what money is, and if you're able to save some money, gold and silver, then one things you have to keep track of the exchange of like how much you can get for an ounce of gold or silver. And when things are out of whack, then yeah, if you're looking to start a business or buy real estate or something, do it. But yeah, in the hyperinflation, the currency just disappears, destroyed. So if you have a little, even just a little bit of gold and a bit of silver, you're going to do very well. But yeah, commodities are going to do well as well, I think, going forward.
Yeah, definitely. Great point. So, Mario, thanks again for your time today. I appreciate it. My last question is, what is one message you want people to take away from our conversation?
Yeah, don't trust anything central bankers or politicians tell you because they're not looking after your interest. So that's all I can. I think that's the most important thing.
It's a good point. You could maybe even extend that to everyone. Don't trust what anyone's telling you, and just do your own
Well,
research.
that too, but especially politicians and bankers.
Yeah, they do have an ulterior motive of trying to keep the current system going, and yeah, they'll do whatever they can. They'll lie about everything just to make people, because they think that if people believe something's going to happen, then that will happen. So it's self-fulfilling prophecy. So they try and prevent people from thinking that for as long as possible until they can't lie about it anymore. As we saw with inflation, they're trying to say no, it's not going to stay. It's not going to stay. They flip that, and now they're saying, no, we're not going to go in recession. We're not going to recession. And I'm sure they'll flip that soon and then reverse. Yeah, perfect. So Mario, thanks again. So if anyone wanted to find out more about your work, your YouTube channel, would that be the best place?
Yeah, that's right. It's Innecco 64 on YouTube. I make a video every day, really, and I'm also on TikTok now. I put some of my videos as shorts on TikTok, and I'm on Twitter as well at Innecco 1964. There are some impersonators, but it's Innecco 1964 on Twitter.
Yeah, nice. I'll put that on the description below, but thanks again for your time.
You're welcome. Take care.
Awesome. Yeah, thanks so much. I appreciate it. It's always crazy. Half an hour just goes so quickly.
Half an hour. Okay.
Yeah. But yeah, I'll probably be uploading this. I think it'll be next Monday, so similar time. And once it's up, I'll share that with you. I'll tag you in it,
Okay.
and yeah, if you could share that, I'd appreciate that.
No problem. Take care.
Awesome. Thanks so much. Same to you.
Bye.
Have a good day. Bye. Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.